Alright, everyone, I don't do this very often, but this is going to be just a short economic retirement update. As you know, inflation has been really high. I did a video a little while ago about how Social Security is probably going to have to raise Social Security by a lot more, even though we had our biggest COLA increase for Social Security in 2022. Most likely we'll have a really large one for 2023. And the reason is because inflation again is still going up 8.6%, but that's really not the, I guess, number that we should be paying attention to, because the CPI number does incorporate a lot of things, and some numbers would drag down the true cost of inflation. So if you ask yourself what is costing the most money in or today as far as what has increased the most, for me it's been groceries, gas, and that's necessities, right? That's kind of things that we need to have. So let's take a look at the numbers and see exactly what those have increased. So food overall has increased 10.1%, whereas food at home, that's the kind of like the food you eat in, and food you to go out is actually 7.4%. So food at home is almost a 12% increase from last year. That's like the groceries and things that you purchase at home, 12%. Energy commodities takes into consideration all forms of energy, so natural gas, gasoline, diesel. And if you look at gasoline, 50%. Okay, fuel oil, 48%. And just services wise, electricity has gone up 16.2%. Gas service, in addition to natural gas having a huge run up, it's almost $9 right now in the energy market. And if I can take a quick look here, what NG is trading at, it's probably trading at way too much. Hang on, let me look here. I can't get futures on my other one. Well, natural gas is down a little bit today, but is still at $8.60. That's a huge amount actually, because if you take a look at the chart here, just go on the daily. Sorry if you're not comfortable with me doing this, but this is what I do all day when I'm not researching on Medicare. So earlier this year, we were, let's just go for fun. Let's just take a look at what January looked like. January natural gas was under $4. Today it's over $8, almost $9. We actually hit $9 last week. $9.20. So natural gas, super expensive. All right, so those are the things that most people need, right? Utilities to power your home, gasoline to drive you around, groceries to eat. And those numbers have gone up substantially, double digits on most. And the reason why it has gone, or the numbers look so far better, 8.6, right? 8.6 is high, but it's not crazy. If you look at food is about 12% for groceries. You look at gasoline, almost 50%. Sorry, actually it is 50%. And that's not easy to stomach. You're going to look at shelter, that's like how much it costs to rent, 5.5%. Transportation services, Uber, 7.9%. Medical services, a little bit lower, 4%. We've been fortunate with, the market and how the market's been doing, and just simply due to the pandemic, we are unable to go and get these elective surgeries. So medical services has been a little on the flatter side at 4%. That's still not good. We want it to be lower than 4, but that's not crazy like fuel prices. We go further into here, and they talk a little bit about what they see as like the trend, and broken down into pieces of it. They go further into saying the meat and poultry food index increased the most, 14.2%, and eggs increased 32.2%. So I don't know if any of you heard, probably not actually, you don't watch all my YouTube channels or all my videos, but I talk about how eggs has gone like almost 2 times. That's what it feels like. You know, it probably went up like $1 or so, but eggs used to be really inexpensive. Used to always have eggs. Now I wait till like I'm almost out of eggs, like 2 left in the carton, to just buy another carton. Before I would buy like 2 cartons at a time, you know, because it was just so inexpensive to have. If we go further down, they actually will break down every single piece of food, energy items, etc. But I mean, I'll link to this to the actual release. This is of course released by the Fed. Actually, sorry, not by the Fed. It's released by the Bureau of Labor Statistics, the Consumer Price Index for May. So it is, like I said, it is a lot, and 8.6 is high, but it's not actually what most of us are experiencing. Most of us don't buy every single thing on the Consumer Price Index. Most of us buy mostly food, gas, and utilities. If you look at your budget, a lot of it goes to those things. So another thing I want to talk about is the stock market. So today the stock market went down a whole lot, and just to give you guys perspective, this is the weekly chart of the S&P 500. For recent memory, for those of you folks who remember, 08 was actually all the way back here. So the housing crash and everything, that's down here. The S&P 500 was, geez, it's saying it's like in the 60s. The S&P, the SPY index, right? So SPY is the ETF that tracks the S&P 500. And that's at, call it 68. Market got completely obliterated at that time. But we chugged along, and we are quite high. And this is the March 2020, when we got smashed again last year, or sorry, 2 years ago. It feels like last year. We've been living in this kind of stasis for a long time, but we got down as low as 210, probably around there, and that is what could happen again if we are, unfortunately, the economy kind of has to reset itself. So I feel like inflation and everything that's been happening is going to help prop up prices, even though it doesn't feel like it. But right around this level here, I'm going to just draw horizontal just so that you can see where it is. So right here is the pre-COVID lows, right at the 1 or the 331 level. So I feel this is not in any way to be construed as any kind of financial advice. You guys have financial planners for that. But I feel that that is a viable place for us to return to. Now, they said, they meaning people who predict economic bear markets, etc., that bear market usually is 28%. So, oops, that's not what I wanted to do. I want to map that price range. So we got as high, the very highs of actually in December, as high as let's just call it 480. So if we go down here, we're right about 20%, which is recession, bear market, ISK numbers. But we usually go in our average bear market 28%. So we could easily see the 340 level and the 331 level being in range. So I just want you folks to be, aware that I'm not saying that's gonna hit it, but I'm saying that for probability wise, it is not gonna be surprising if we do hit the 330 level within the next, I'd say, couple of months, unless we have some really good economic news. Now it's gonna chop around like this. Nothing ever moves in a straight line, but that's kind of what it's pricing in. And if we took a look back at the markets here, the markets are pricing in 2 months in August. Markets are pricing in a 36-point move, which is just about 340. So 340, and then if we go further, I guess heading into the end of the year, that's where we have the 64-point move, which would take us below 320. So the market's already kind of pricing in quite a bit of movement. Yeah, it looks like the 330 level will be approximately somewhere between October and November. The 1 standard deviation move. Gosh, my math is off. Oh, you know why? Volatility is expanding, so the option pricing is expanding as the market has hit downwards. So we actually may be hitting it here. Yeah. So August, the market has priced in that the 330, 335 level is going to be within the expected move, which is 1 standard deviation of kind of movement. We, as option traders, like to say it's a 16 delta, yeah, with 84% chance of probability, is, where the expected move could go. And so yeah, there it is. It's kind of where it's showing. So to be within normal variance of market movement. So just be aware of that. Not to scare you, not to say do anything or don't do anything, just education, right? Just the knowledge. So what can you do? Well, you could go, if you wanted to, again, not financial advice or anything like that. There are things called I-bonds. You can buy up to $10,000 worth of these I-bonds. They're currently paying 9.62%. You buy them direct from the government website, treasurydirect.gov. Not saying you should go do that, but it is something to think about. And you can get them through October 2022, and you'll get the 9.62% semi-annual. So it is actually going to be half of that paid for 6 months of holding it, and then the interest rate gets changed. Now the interest rate can change every single 6 month period, and it will, and then right now it's really high. So I would say that this is something, if you want to take a more active, proactive approach to your investing and you think inflation is going to remain high in the overall, again, the CPI again was 8.6. The CPI-U, which is the consumer price index, not seasonally adjusted for urban customers, is a different index, but it's a little bit higher than the regular core CPI currently. So it's showing at 9.62%. So something you can do. Again, just wanted to get it out there about what's going on in the market, because we have it's a really bad day. The S&P 500 is down 3.22%. The Russell is down 4.35. Technology is down. Oh, what is technology now? Let's go take a look. Technology's down almost 4%, and I'm pretty sure the Dow Jones is down, almost 2.5%. So Dow Jones is the strongest of the 4 major indices, but definitely still getting hammered. So just perspective. Like I said, don't do anything. Don't not do anything. If you're just just understand what's going on, so that you can make better decisions based on what's going on. And also that even though the CPI said that everything's only going up by 8.6%, we know that that's not the case. Things that we do most of: eat, consume energy. Those things are up double digits. Our personal inflation rate, I mean, you can, if you're if you're a nerd, you can calculate it yourself, but most people's personal inflation rate is not going to be 8.6%. It's going to be higher, especially if they're retired already and have a fixed social security and a fixed income based on the stock market. You're also bleeding on your asset side, so you're going to be experiencing a huge shift. So hopefully you took some profits last year, made some adjustments perhaps this year for that, change in cost. But yeah, keep those things in mind. Again, things always change. For Medicare this year, Medicare is fortunately going to reduce the Part B premium. Medicare Advantage plans are going to get a bump in their, contribution from the federal government. Medicare supplement plans probably will see rate increases as medical care services inflation is up 4%, so we're at least going to see a 4% increase in premiums overall, but hopefully the Part B reduction will kind of lower the blow of having to pay more for your Medicare supplement plan. Part D drug plans are unfortunately getting progressively weaker due to new regulations on having a lot of the Part B medications moved over to Part D, which will cause a lot of plans to have to price in more expensive medications that are typically provided in the doctor's office and not in the pharmacy. So that could be something to look out for. I had a video which kind of showed how you can see and maximize everything available in picking up drugs from the pharmacy. I'll try and link it down in the YouTube video, as well as if you receive the email, hopefully it's in there as well. And again, if you do have any questions about things like this or like this kind of information, subscribe, let me know so that I can get more of this stuff out. This is just a video that I'm doing especially because the numbers came out, and when you read into it, I mean, it's not really what's going on. And then again, the market took that news and really dumped it and is continuing to dump it. This week, FOMC, we have triple witching in the option expiration, which means that there are 3 batches of different types of options that all expire this week, Friday, June 17th. We got futures, we have the regular stock options and commodity options, so it's going to be a huge kind of close on Friday, which will be really violent. So just be aware that maybe you just don't look at anything this week as far as your stock portfolio is concerned, and kind of just maybe eat out, because that's a food takeaway. Going out, Dow only went up 7.4% versus food at home, which went up 11.9%. So maybe go out, save a little bit of money in an inflationary standpoint, which is less than 8.6%. So it might be a good deal. But anyway, enough chatting. I have to get back to trading the close, and I'll see you next time.